Hello everyone, today we're going to be talking about a bit of education. What I want to talk about today is how to trade with the trend. Now, when it comes to your technical chart work, there's little that's more important than being able to trade with the market. Traders who trade with the market are going to make much more profit and have a much better time than those who are constantly fighting and trying to catch reversals. So trend trading is very important. Now, before we get into it, what do I mean when I talk about a trend? Well, I'm essentially talking about the direction of the market. We have two different trends, uptrends and downtrends. Now, the market also moves in another phase called consolidation. Consolidation phase is where the market's moving sideways, like this. And then the uptrend is when it's moving up, as you can see pictured. And the downtrend is going to be when the market is moving down, like that. So in this video, we're just going to talk about the uptrends and downtrends and how you actually go about trading with the overall flow of the market. Trends will form across all time frames. We see trends on the daily chart, the weekly chart, the monthly chart, and we also see trends as low as the 1 minute chart and the 5 minute chart. Now, they're always going to look slightly different, but they always follow the same principles. We have three stages that we're going to see in every single trend across every single time frame. The components we're going to see are impulse moves, correctional moves, and highs and lows. So an impulse move is a move with the overall flow of the market. In this example, these moves here are the impulse moves. The corrective moves are the pullback moves, the smaller movements that go against the trend. These also form in every trend. Sometimes at different sizes, but generally, the rule is the impulse move is the overall direction of the market, and the corrective moves are always going to be smaller because they never really surpass the previous low. So we have our impulses. We have our corrections. Plotting this all out for you. And then the final thing I said was that we have highs and lows. Now, the highs and lows in the market form between the impulse and corrective moves. We have higher highs, higher lows in an uptrend, and we have lower lows and lower highs in a downtrend. So we're just going to focus on this uptrend example for now. And there we have the overall flow of a trend. Impulsive move forming a higher high, a corrective move which then forms a higher low, another impulsive move which clears the previous higher high and forms a new higher high, the corrective move which then forms a higher low, which is a low that's higher than the previous, and then another impulsive move, and so on. Now, these can continue for a long time. They can also simply be just like this, maybe two corrective moves, and then the market will reverse completely. Trends come in all different sizes and last for all different lengths of time. And there's no set way to know exactly when a trend is going to end. But if you can ride with the trend while it's happening, you can make some good profits, enough to actually be consistent and to make some good money week by following the trends in the market. So we're going to see this kind of movement. Higher highs, higher lows, higher highs, higher lows, impulses and corrections on all different time frames in all trends that we find in the market. And these are the things that we're going to use to actually identify and trade a trend. Now, the biggest thing to consider is the higher highs and higher lows, because really we know that the impulses and corrections are happening if we can just understand the higher highs and higher lows. So what I'm going to do is just remove these for now and show you why the highs and lows in a market are so important. Now, we spoke about the higher high and higher low formation, where we continually form up like this. And a trend reversal will really come into place when we then clear one of the higher lows and form a lower low. Does that make sense? So this is a trend reversal. Now, we're not going to be talking too much about these in this video, but I'm just giving you an understanding of the structure and showing all examples. So as you see here, the market will push past this previous higher low, come in and form a lower low. And that is where we see a change in the trend direction. So notice how we've gone from higher highs and higher lows into lower lows and lower highs. That is a trend reversal. So until this happens, we can continue to trade with the trend. And that's why the highs and lows are so important in actually gauging the direction. Because if the market is continuing to form higher highs and higher lows, we're good to go. When it starts to break through and begins forming lower lows and lower highs, that is where the market is coming to the end of its trend and it's time to cut off our trades. So this is called market structure. I'm a big advocate of market structure, and it is, for me, the biggest part of price action technical trading that is going to help you to succeed. If you can just trade with the structure and continue to ride the market up when it's riding up, and then ride it down when it shifts to down, then you are going to have a good time in your trading. So the key to finding our trades is to identify the market structure, and when we know that we're in an uptrend, we can then use corrections to look for entries. So down here in the higher low area at the end of a corrective move is where we want to get our entry. And then what we want to do is ride from that entry through the impulsive move, and that is where the profits are made. Does that make sense? So we're looking for the market structure. If we're in an uptrend, we then want to use the corrections to buy from and ride the impulse for our profits. And if we're in a downtrend, we're essentially looking for the same. Now, in this example, we would have lower lows and lower highs rather than higher highs and higher lows. But other than that, everything is exactly the same. We are looking to sell the corrections and ride the impulse down, and that is where the money is made. Okay? And until this shifts and until we actually then form a higher low in the trend, we can continue doing this until the trend tells us not to. So what we're going to do now is move over to a real chart scenario, and I'll show you this in action, the higher highs and higher lows, the corrective entry, and the impulse profit. And then I'm going to show you a few tips to actually secure the entry, because it's good to know that we need to enter at the end of a corrective move, but how exactly do we do that? And where exactly would we get our entry in? That's what we're going to talk about just now. So I will move over to the charts and we will continue talking there. So for the example, we're going to be looking at a downtrend on the Euro USD chart. I've got that boxed off here. And what I'm going to do is just plot out the path so you can see the overall structure of the trend. So, as we just spoke about with the impulses and corrections, hopefully you can see that on the chart. We begin here with a high. We then form a lower low beneath this one. We have a corrective move, second impulsive move, and a second corrective move. So, what we would be looking to do is continue to ride the trend down. So from this point, we know, okay, we're in a downtrend. We formed lower low, lower high, lower low, lower high. We could potentially look for an opportunity to run this trade lower and actually ride down the next impulsive move in this downtrend. And that's the whole idea. We just want to ride with the trend, with what the market is showing us right now. If the market is telling us that we're in a downtrend with these impulses and corrections, we can then look to ride this downtrend as far as possible before it gives us indication that it's reversing. So how would you actually go about finding the entries for these trades? Well, the two things that I like to use in my trading the most are key levels and supply and demand. They're super simple, but they're super effective. When I talk about key levels, I'm talking about key price points, rounded off price points. Now, these are essentially support and resistance levels, but I use the support and resistance levels with the rounded off point zeros, 0.250s, 0.500s, 0.750s, and then back to the point zeros again. So we have essentially 25 or 250 pip intervals between each movement in the market. And the key levels generally bring some really nice reactions because they are the levels that institutional traders and institutional market participants are looking towards for entries and for profit taking. Now, in my experience in the markets, key levels have been, for me, the only method of support and resistance I use, unless, of course, I'm trading the super low timeframes. because on those levels, we won't generally have these tapped as often. And when I talk about them, I'm talking about the 1 minute and the 5 minute charts. When you're trading that low, it's hard to actually focus on these big price levels because there's so much going on, so much noise in the shorter term time frames of the market. But when we're trading on anything above really the 15-minute chart or so, the best levels to focus on are these key levels. And this is the first thing I will do when I'm actually looking to find a potential entry. So as you can see, we had this high point in the market. Then we came in down here and we took out this low. Okay, so you can see the wick there. We took out that low with these wicks here and the bodies as well. We took out these bodies with these bodies here. So we formed here a lower low. So we can look then for the next move in the market to form a lower high. And what we would be looking for our entry is the key levels and also supply and demand. Now, supply and demand is essentially where institutional market participants, so banks, hedge funds, large traders with large capital on an institutional level, are looking for entries. We identify supply and demand by looking at consolidation phases before large uninterrupted movements in the market. Now, as you can see, we have this push up, a little bit of consolidation, and then a big push down. So this would mark out an area of supply. Supply is an area where the institutional traders will then look to sell the market when price taps into that region. So pairing the key levels with the supply and demand in this instance would have given you a brilliant entry to sell the market down. Now, when we were looking to do that, we would have put our stops above the previous high of the supply zone, and then we could look to bring it down to previous price points, generally further than the past lower low. Okay, so as you can see, for example's sake, a nice trade was formed there by pairing the key levels and the supply and the demand levels together to actually bring this market down. So when we've got the key levels and supply and demand, for the added accuracy, we could then scale into the lower time frames. I'm not going to go into too much of that in this video because it is essentially just a small snippet video to give you some solid education, and I don't want to confuse everyone and go too off track and make it too long. But you can use then the 4-hour chart, the 1-hour chart, for example, if you were looking at trends on the daily to find some entry confirmations around this point to sell the market. But the major principles you're going to be using are key levels and supply and demand. Now, when it comes to your targets, you may be targeting previous key levels and previous areas of supply and demand. So for example, we could look towards 1.12750, which as we can see is a previous support twice in the past. And if you'd have done that, you could have brought price down quite nicely into that. You can see how it reacted quite well from that level. Previous 1 to 3 times support. Okay, and we know that it's most likely going to surpass this level because we are in a downtrend and the impulse is going to be bigger than the previous correction. So let's actually have a look then at formulating a trade from where we are now. Now in this example, the supply zone would be up here in the highs. Key levels, however, if we plot them on, 1.140 sits right above where price is now. And these wicks tell us that the market is rejecting. So it may be an opportunity here where we avoid that supply and demand and actually have a look if there's an opportunity off this key level to sell the market. So as an example, bringing it down to the 4-hour chart to find those confirmations as we spoke about, we would want to see how the price reacts around this 1.14 key level. If the key level holds, we can look to sell. If it breaks, we could then look towards the supply zone for the entry. Now, what I'm going to do is just plot off this trading range that we can see that the market is in. And this is really where we would be looking for our opportunity. Now, it really is as simple as that. We know that the market is now ranging, so if it breaks out to the upside, it's not time to sell. If it breaks out to the downside, however, we've seen a key level reaction. We know that we're at the end of a corrective move, potentially, and we could then look to bring the market lower from here. So letting the market do its thing, patience is required when you're trading always. See a little bit of consolidation. We'll be looking for a nice strong closure above or below. And when we get that, like this bearish closure here, which is evidently broken out of the trading range, we could look to sell with our stop over the high and bring this thing down into previous key levels and previous areas of supply and demand. And if we just focus on this previous support, for example's sake, towards 1.1 1 to 150, this could very well be the next impulsive move of the market. So allowing the market to play out, we can see that it slowly but surely makes its way towards that target. And that is essentially the whole process of how to get started trading with the trend. So now, hopefully in this video, you've learned how to identify trends using the impulses, corrections, higher highs and higher lows. And now hopefully as well, you have an idea of the key factors I use, the key levels and the supply and demand zones to actually trigger my trades and find the entries for trades. Of course, there is a lot more to trading than this, but if you can grasp these concepts, if you can learn how to read market structure, you can learn how to read supply and demand. I do have videos of that over on my page, and you can learn how to use key levels effectively, then you can get some really simple and effective trend trading trades without too much work. So I hope you benefited from this video. If you have, please do drop a like, please do subscribe. In the future, I'm going to be doing one weekly educational video over on my channel. So if you want to stay up to date with all of those, make sure you're subscribed. I will be soon making a trend reversal video as well, as we mentioned earlier, where we look for the breaks of the market structure, the breaks of the highs and lows to find trading opportunities. I'm going to show you in the future how to trade those. So thank you for watching. Hope you've enjoyed, and I'll see you over in the next video.